In this video, I'm going to show you how you can consistently execute the three most vital tools you need when trading. A lot of traders are unable to put these concepts into place properly, or they are using them incorrectly, which leads to a lot of losing trades. I will explain everything you need to know A to Z so you can master these concepts and trade them correctly. So let's get straight into it. Now, to start off, everything that happens in the market can be divided into three key factors. Starting off with number one, volume. Now, volume is simply the amount of traders or money available in the market. A market with low volume usually consolidates with little to no movement. Now, think of Asian session on Euro USD. When we have more traders in the market, we have more money in the market as more traders are placing orders. This leads to more liquidity in the market, which brings us on to our second point, which is liquidity. Liquidity simply refers to orders. Where there's higher liquidity, there's more orders. Where there's lower liquidity, there's less orders. Or you can put it into other words as traders. Where there's more traders, there's higher liquidity. Where there is less traders and less positions open, there is lower liquidity. Market is constantly doing one of two things. One of them is seeking liquidity. Now, market is constantly seeking out liquidity through old highs, old lows, trend lines. Anywhere where there is a high number of orders or a high number of active traders with open positions, market is looking to take them out of their positions. Remember guys, Forex is a financial market. For you to buy an asset, there has to be someone willing to sell that asset. Now remember this will be a key point throughout this video. If I am looking to buy an iPhone, I go to the Apple store and they have to be willing to sell me an iPhone for me to be able to buy that iPhone. Key point being, if you want to buy an asset, there has to be someone willing to sell that asset to you. And if you want to sell an asset, there has to be someone willing to buy that asset off you. Now, how does this relate back to Forex? Forex is the exact same. It is a financial market. There are buyers and there are sellers. Where there are buyers, there needs to be people selling. And when there are sellers, there needs to be people buying. Usually, this is not a problem for us retail traders, as retail traders make up 95% of the market. So we do not have any difficulty getting into positions. Now, what if a large market participant, for example, let's bring up the Apple store analogy again because it's quite tangible. Say if someone wanted to go into an Apple store and buy 500 iPhones, would the store have 500 iPhones? Most likely not, so they would not be able to buy 500 iPhones. This is how it links back to trading. This is where large market participants come in. Large market participants being hedge funds, banks, etc. Now, these large market participants, or smart money as we call them, they have huge orders with thousands and thousands and thousands of lots. They are unable to execute their orders without the liquidity necessary. As I said, guys, if they want to buy, there has to be sellers in the market. If they want to sell, there has to be buyers in the market. For example, if they are looking to buy Euro USD, if they are looking to buy, let's say, for example, $100 million worth of Euro USD, there has to be $100 million of sellers in Euro USD for them to be able to buy it. Now, because there is not always the liquidity necessary for them to execute their positions, they instigate retail buying and selling to fund their positions. What does this mean? Smart money, or large market participants, will create a scenario or a market which will influence traders to trade in order so they can use them as liquidity. What do I mean? We are all familiar with the concept support and resistance. As you guys can see on this diagram right here, we have our resistance up here and we have our support right here. What do retail traders do? They buy at these points right here, as they call this support, and they sell at these points right here, calling them resistance. Now, smart money can't actively see where the orders are in the market. They cannot see these retail traders placing buys here, and they cannot see these retail traders placing sells here on the resistance. However, they do have a clear idea as an understanding of liquidity goes. There will be sellers here with stop losses up here, and there will be buyers here with stop losses down here. With this knowledge, they know if they trigger these stop losses, they get these people out of the market and they can use their positions to fund their positions. For example, if market took liquidity to the downside, we know their stop losses would be triggered. These buyers would be out of the market. Now, because they are buying, once their stop loss is triggered, they have to sell their position at a worse rate. Now, if they were buying EURUSD, for example, at a certain price and they got stopped out, this means they have to sell their position at a worse price, which means they lose out on their trade. They lose money on the trade. Same as for selling. If market were to come up and hit stop losses up here for these sellers, they would have to buy back their position at a worse rate, leading to a loss for them. This means, for example, if these sellers were stopped out right here, there's a load of buy orders right here. This is why we call it buy side liquidity up here and we call it sell side liquidity down here. Now, because there is a lot of buy side liquidity right here, this means smart money could theoretically place a big sell order right here, which would make market go down like this. And the same in this scenario, if market were to take liquidity to the downside, we would have a lot of sell side liquidity, which means smart money could place a buy. Remember guys, Forex is a financial market. If you're trading indices, commodities, whatever it is a financial market. If you want to sell, you need buyers. If you want to buy, you need sellers. This brings me on to my next point. How does smart money or large market participants actually take out this liquidity? Now, they sweep this liquidity by placing huge orders in places such as this high right here, or they may place it right here, where it manipulates price due to the sheer volume they are trading with. As I said, guys, they trade with huge contracts with thousands and thousands of lots. So this manipulates market and pushes price down in our case, for example. But for our example's sake, let's say smart money has placed huge sell orders right here, where they have driven price down to trigger the stop losses of any retail buyers right here. Now, these large market participants need this liquidity in order to fund their main position. Remember, guys, this is not their main position, and I'll get onto this point in a bit in the next slide. This is just simply to take out the liquidity so they can take this sell side liquidity in order to place a huge buy order right here. Now, smart money cannot close these positions just yet, even though they are in profit with this position right here. And if they would to place a position right here, they are in profit with both these positions. However, they cannot close it. One, they do not have enough liquidity, and two, it would lead to inefficient price action. Now, since the retail traders are out of the market and there is a ton of sell orders right here, if they were to just carry on selling, they would just push market downwards with extreme volume, with a lot of volume. This would cause other traders who are buying, say, in further points in the market on the monthly time frame, weekly time frame, they will all be closing out their trades, and there'll be more people selling until we get a flash crash. Now, if you guys do know what a flash crash is, it's when market moves hundreds and hundreds of pips in a very short time, and it is really not good for anyone. So smart money understands this. They do not want inefficient price action. They want to place their trades properly and make a profit. With all this sell side liquidity and these buyers out of the market, smart money can finally place their buy order. Now, this buy order is way bigger than these sell positions, as these sell positions' main goal was to fund this buy order right here. Because smart money has placed such a big position right here, it manipulates market. It has a huge influence on the market due to the sheer size and amount of orders that are placed right here. So this creates a surge of volume and it manipulates the market into causing a big bullish move towards the upside. Because there is way more buyers in the market right now than there is sellers, causing market to move upwards. Now, both buyers and sellers will have eventually be taken out of the market. First, we've had buyers taken out of the market, and once market moves up like this, we get sellers taken out of the market. All while this is happening, smart money is still holding these positions at a loss right here. Remember, this position is way bigger, so overall they are profitable, but smart money does not want to take a loss on these positions because smart money rarely takes a loss. In these financial markets, they are heavily manipulated to the point where retail traders are the ones losing majority of the time. Rarely does smart money ever lose, if they even do lose at all. So this brings us on to order blocks. Now, smart money closes their sell orders at break even once it returns back to this point in the market. Now, sometimes they'll even close their positions at a loss just in order so the market can continue in the direction for this buy order right here. Now, smart money is not only able to place this buy order right here and get a huge move upwards, they are also able to manipulate market downwards in order to close these positions at break even, where normally in the market there would be some consolidation here, more liquidity be taken out. There will be more instigation of retail buying and selling, so market can come, sell this market again, and possibly come back to close it at break even once again. However, for simplicity's sake, we will not focus on that. We will simply focus on the order block right here. Now, this brings us on to how an order block is actually formed and what is behind an order block. As you guys can see, an order block is simply the last down move before the up move, or the last up move before a down move. We as traders simply see this area as an order block. We see price move away from the order block, possibly consolidate up here and return back to our order block. That's how we see it as traders, and this is how we can take advantage of this concept right here. Now, the same logic can be applied to breaker blocks. Now, if market were to come and manipulate and sweep above these highs, stopping out any retail sellers right here, triggering their stop loss, and using that buy side liquidity to place a huge sell order in order to push price downwards. Now, once they do place this buy order up here, once price shoots up from the sheer amount of volume up here, once price moves upwards, price would only have to return back to this breaker block right here, as we call it. This is the concept we know as breaker block. Price would have to return to the breaker block in order for them to close their positions at break even before market does continue in the desired direction, or the bigger position, which is their buy order. Understanding how smart money moves, or large market participants, or just simply understanding the concepts behind breaker blocks and order blocks can really help your trading. I'm going to go into the live market and show you guys a couple examples of this on the live market. So let's get into it. Here on EURUSD on the 4-hour time frame, I will show you a classic textbook order block setup. Now, as you guys can see, we are in a consolidating market right here, where retail traders would call this resistance, where they'd be selling right here and buying at these points in the market right here as support. So what smart money will do is drive price downwards or upwards to take this liquidity that is resting above here and is resting below here. So smart money is looking to take these stop losses. If I play a market, you guys can see smart money presumably would have pushed market down by placing a huge sell order here, which would manipulate price to then trigger these stop losses, which funds their position for them to buy big right here. All this buy side liquidity allow them to buy sell side liquidity, sorry. Playing out market, you can see market has consolidated a little bit, and you can see the points on the graph where market has the most volume. Right here, you can see where market has bought, we have the most volume. This shows that our theory is correct, as the point on the market with the most volume is where our order block is formed, showing us smart money is involved. Only smart money can move the market upwards like this in such an aggressive manner. Now you'll begin to see market return back to our order block just to close their positions at break even in order to not take a loss on this trade. And you guys will see market will just form a little bit of liquidity right here before moving in the desired direction, which is to the upside, which is in favor of the bigger position. And as you guys can see, market does move towards the upside. Now, with order blocks covered, we are going to move on to inefficiencies. Now, inefficiency along with volume and liquidity, these three concepts can be used to explain every single move in the market. Now, I stated earlier, market does one of two things. The second thing market does is filling inefficiency. So when market isn't seeking liquidity in the form of old highs and old lows, market is filling inefficiency, or as most of you guys would know it, fair value gaps or imbalances. Now, these fair value gaps and imbalances occur when the market has a large volume of buy or sell orders with little to no volume of sell or buy orders. What do I mean by this? I'm going to bring you guys to this diagram right here of our inefficient price action, and as you guys can see, we do very clearly have a fair value gap right here. The reason this gap forms is because there isn't efficient price action. What does this mean? It means there are way more buyers in the market than there are people selling. Now, this causes price to jump quickly as the volume of buyers is way stronger than the volume of sellers. However, this price does not reflect market's true value. So what market will have to do is come back and return back to this zone. Market will return back to this gap in order to fill the unfilled orders in the market. What do I mean by this? Now, within our fair value gap, as I've explained, we have a lot of buying pressure. We have way more buyers in the market than there are sellers. Now, due to the lack of sellers, some of these buyers are unable to execute their positions within this gap. This leads to unfilled orders being left in this gap. So some buyers which are unable to get into the market because the lack of volume, the lack of sellers in the market. As I said, guys, financial market, if you want to buy an asset, there needs to be sellers. If there are no sellers, there will be some unfilled orders right here. So once market comes back, and as you guys can see in this diagram, once market comes back, returns back to the fair value gap, fills these orders, we get a new surge in volume pushing market to the upside in our scenario. Now, for a bearish example, it would be exactly the same but flipped. Fair value gaps are a very useful tool not only for entering trades into the market but also for framing your buyers. I'm going to hop onto the live market and show you guys a few examples. So let's get into it. We are back on EURUSD on the 1 hour time frame, and as you guys can see, market has pushed up quite strongly to the upside where we are displacing old highs, and we have this large displacement candle here, which is our fair value gap made up of a 3 candle formation. Now we have candle A, candle B, candle C, and within candle B we have a huge gap, which is our fair value gap. Now in this gap, there is unfilled orders due to the amount of volume. There is way more buyers in the market right now than there is sellers. So some of these buyers were unable to get into the market, unable to execute their positions due to the lack of liquidity. So what market will do is come return back to this gap and take this liquidity, use this new surge of buying pressure to then push market upwards. So if I play out market, you can see we fill in the fair value gap. We fill in all those unfilled orders, and as you guys can see, we get a new surge in volume towards the upside, where market will presumably go to the next point of liquidity, which is this high. And as you guys can see, the market goes to the next point of liquidity before then reversing downwards after taking out all this sell side liquidity right here. Now on to the third and final concept you will ever need: rejection blocks. Now, rejection blocks use the same logic as the order block, however, they are just portrayed differently because of the time frame. So, what actually is a rejection block? A rejection block firstly consists of 2 candles where the wicks should sweep liquidity ideally. Now, it doesn't matter which wick is longer as long as the wicks do sweep liquidity. If the candles close within the liquidity, that is also fine, as the whole point of a rejection block is for it to sweep liquidity. And they usually indicate a change of character or a market structure shift. So when you do see a rejection block happen, you can be more than confident that market is reversing and we are going to head in the opposite direction. Now, our main point of interest for rejection blocks is the wicks. I will show you guys on the chart what I mean. Alright, here we are on EURUSD. I am currently active in a trade where I have sent this out to the signals group, and I have used a rejection block in order to frame my buyers for this trade. Now, this group was sent out to the signals, the VIP group, and we are floating about 1.2k in profit right now as shown right here. Now, coming up to this sweep on liquidity, as you guys can see, market has closed above this old high right here. And as you can see, we do have a wick closure and we have with this wick sweep liquidity right here before we get our reversal. Now, if I hop down to the 1 minute, which is where I got my entry, you can see I actually did get an order block entry right here. So rejection blocks are simply order blocks just on a higher time frame, and they can help you frame your bias. So as you guys can see, I saw the sweep of liquidity from the rejection block, so I knew market was going to reverse, and we did have market consolidate quite a bit before pushing down, hitting 1, 2, 3, where we could take some partials and hold until we hit full take profit. Now, if you guys want to be involved in taking your trading to the next level and seeing signals and market analysis and having all questions trading related answered, make sure you guys join the VIP group. It is at its insane price right now, at an insane discount. If you are looking to take your trading to the next level, get live signals as such, get market breakdowns, get analysis breakdowns, have all your questions answered, and really become profitable and make a living off trading, make sure you guys check out the link in the description. And that's all I have for today's video. I hope you guys take away what liquidity is, volume, inefficiency, and how they do form order blocks, fair value gaps, and rejection blocks. Use it into your market, implement it, and become profitable. Thank you guys so much for watching, and I'll see you guys next time.